Hi everyone, hope you're all doing well. We're back here on the 2 hour chart for silver on Thursday, November the 1st. Hope you guys had a great Halloween. It's definitely one of my favorite holidays of the year. Now, last video we were talking about this downward channel that silver was trading in, and it appears now that we have broken through this downward trend, and we're able to consolidate our levels of support and resistance. Again, we had a level of support right down in this level, which was tested a number of times, and also a level of resistance right here at this level. Now, last night we were able to break through this point of resistance, and it looked like we had a potential volatile move upward, which is what tends to happen when you break levels of support or resistance. You have quick moves to the upside or downside. However, we have come back down, and what I'm going to be watching for now, the market is still trading, but I'm going to see if this level here becomes a level of support, which was previously our level of resistance, which would mean that we would bounce off here and then continue moving on higher. Or I'm also going to see if this upward move fails and we go back down to test this level of support and continue our sideways movement, or if we go and break through this once our previous level of support and continue on testing the $30 price range. Now on the MACD, we have turned back downward, and it appears as though we are currently breaking through the signal line right now. However, I just wanted to point out that on the daily chart, the MACD has turned back upwards, and it appears as though it is possible on this daily chart here that we are going to break through the signal line and possibly go through the zero line as well. So again, we'll keep an eye on this and look for more videos in the future on the silver price. Now, moving away from the silver chart analysis, I just wanted to do a video on the recent decision by the Bank of Canada to leave interest rates at 1% for the 17th time, and to also just rebut the notion by the Bank of Canada Governor Mark Carney that the case for adjustment of interest rates has become less imminent. And I believe he means less imminent in relation to his statements 6 months ago back in April. Again, we did a video on this article back at the end of May. If you remember, the Bank of Canada governor had said that Canadians were absorbing his message of prudence and caution, and he was a little bit more optimistic then, since the rate of the annual growth in household debt to income had slowed and had only been growing at 4% a year rather than at 10% in previous years. Now, back in April, Canadian household debt to income was at 153%, which means that for every dollar that Canadians earned in income, they had $1.53 of debt. Now, looking at today's numbers, this article mentions that the current household debt to income is 161%, which means that in the 6 months in between now and April, Canadian debt to income has increased at 5%, which means adjusted annually, we're back at that 10% rate that had people so pessimistic before. And really, I think that that's a clear indicator that we are in an imminent situation where interest rates need to rise. Again, people need to be able to make more money off their savings and have an incentive to save. Again, lower interest rates, nobody's going to, or at least they would be less inclined to save since they would be earning such a low interest rate. And again, not even being able to keep up with inflation. But also, too, low interest rates are an incentive to go into debt. Again, if you have low interest payments, somebody might make a decision to, take on an additional mortgage or to take on a bigger mortgage than they would have otherwise taken on with interest rates being so low. So again, I don't know where they get these ideas that we're in a less imminent situation needing interest rate hikes. But again, if we look down at the housing market comments, again, if we see Mark Carney again states that there might be signs of overbuilding. However, the level of housing investment still remains near historical highs. Now again, you could have said the exact same thing in 2005 and 2006 for the US housing market in an argument that we weren't in a housing bubble. So again, to me, higher, historical highs of housing investment would indicate to me that we are in a housing bubble. And I think that that's the real reason why interest rate hikes seem less imminent to Mark Carney. Really, he's in a no-win situation where if he raises interest rates, he's going to crash the housing market and the economy with it. Or if he keeps interest rates low, then he's going to allow Canadians to get into more and more debt and again just postpone the inevitable crash, which is going to take place at some point. So again, I'm going to argue to Mark Carney that again, we are in an imminent time which needs interest rate hikes. And again, I would say to him, don't wait until 2014 and 2015. Don't become the Canadian branch of the Federal Reserve, again, by keeping interest rates perpetually low into the near future, into 2015. Get those interest rate hikes now, and again, allow Canadians to wean themselves off of getting into debt and allow them to have an incentive to start saving. So again, thank you everyone to who's watching and who's been patient with these silver analysis videos. I've really enjoyed doing them and hearing your feedback on them. So again, if you could like, comment, and subscribe, that's always greatly appreciated. And again, that's it for now, guys. We'll talk to you soon.